Matt, let's have you start this off. This is what you said for 2Q 2023 earnings predictions. Matt says revenue of 550 million, 16% year over year growth. U.S. commercial surpasses 125 million a quarter. Adjusted cash flow from operations. Yep. Oh, there we go. I got it. Of 180 million. Cash surpasses 3 billion. Interesting. I didn't think of this one at all. Customers 441, up from 308 and 391 in first quarter, up 43% year over year and 13% quarter over quarter. That 43% year over year growth is amazing. And commercial customers surpasses 310, up from 280. Any justification behind these numbers? And then after you go, Arnie, I want to get your thoughts on these numbers, and then I'll share your chart.
The easiest one to talk about is the customer count. So I think if you looked at 1Q 22 versus 1Q 23, I think it was up over 40%. So it's not too much of a difference. I'm anticipating that you'll get some new clientele on with the use of AIP and the kind of the enthusiasm around that, and how that people can kind of truly start to embed AI in a very systematic manner into their organizations. What the thing that I mostly was thinking about was the commercial customers surpassing 310. I think that was like about 10 or 15% quarter over quarter growth. I'd love to see that, but that's not too dissimilar to what we've been seeing. We've been seeing anywhere between 12 to 14% every quarter, kind of on a very steady pace. And so my hope is that we continue with that. How I came up with the revenue was, as you can see, it's still only 16%. I anticipated about a 5% revenue growth in Europe, or I guess non-US revenue.
And is there any reason for that, or you kind of just think international?
I still don't. We still haven't fully unlocked the NHS deal. There, we did knock out the Ukraine deal, but I don't think money's going to be showing up for that as of yet. I think that you still have some time for that. So I haven't really seen too much from a European perspective of impacts this quarter, right? Something that was started a year or so ago that would really have a huge fundamental change. Maybe you start to see some sort of Ukraine revenues kind of coming through that, because you think about it now, I mean, they've been helping Ukraine now for just under 18 months.
18 months,
maybe it starts to show up, but I don't know if we're still offering that technology for free, or if we're using it as a battle tester and partnering with Ukraine to kind of say, okay, this is more of a NATO specific military application that we'd like to develop. So we don't mind working for free with Ukraine because it'll battle test it. That I don't know, right? You could end up seeing something where it's, especially now that the United States is giving billions of dollars in terms of aid, maybe they're helping pay for some of the Palantir bills. I don't know. But the rest of it, I continue to see more and more people doubling down in the US, specifically the commercial and the government as well. I mean, you saw, and I think you labeled it in one of your tweets, Amit, where we had several US Army contracts go through, and those are all very shorter term, like 2-3 year contracts. So that should start hitting the increases or keep up the net dollar retention for the company.
And you think that will help us beat the 532 that they told us to expect? You've got them at 18 million.
550. Yeah.
550.
I know it's bullish, right? This is kind of more of an upper edge, I would say. I really wanted to just be like, okay, that makes sense. But what they were going for was a 12% year over year. It was at 473 last year in 2Q. 12% would have been, just under 50 or just over $50 million more than that. So that gets you to the high 520s, low 530s, just like they forecasted, right?
Yeah.
I think they forecasted the upper range of 532. And I just like, you know what, man, like I really, maybe it's more of a hope and a prayer than anything, but I'm just very confident that they've seen some things come through that I think they were hedging for that will start to pay dividends. And if you think about it, $18 million in terms of a 4-quarter run rate is less than $60 million annually. It's really not too big of or I guess it's $72 million. And I'm not good with math. You guys know that. $72 million annually. It's not too big of a pump up in terms of, annualized revenue numbers, right? But, I think, I don't think when they released 1Q, they maybe had finalized the release date of AIPCon as of yet. I know that they were kind of like teasing it to an extent because it is in the presentation.
They're also, we got to assume they're sandbagging, like at some level. We got to assume.
Yeah, I mean I think that's the hope. But anyway, I've been talking for too long. I will say though, I'm not going to be surprised if they come in at 530, just like they forecasted. But my hope is that they were sandbagging just a little bit. And to be fair, I think where I care more about is the customer count. So if the customer count appreciates at over 50% year over year, I think that's more important than
Agreed.
seeing the revenue growth go to 550 for the quarter.
100%.
But I think that we need to get closer to a $2.3 billion fiscal year 23 to truly get back towards where we need to be. And I'm hoping, we don't go to the 2.23 or something that I think we're forecasting. But I think the $3 billion is very easy. I think that we continue to add about $100 million a quarter. I don't think that's very unfeasible. What the hell they're going to do with that $3 billion is beyond me. But I'll kick it back to you guys because I've been chatting for too long.
Okay, Arnie, your thoughts on earnings predictions, and then take us through some of the thoughts you have about valuation right now.
I'm very aligned with all what Matt said, but just to make one step back to what we were discussing before, here is the chart where we can see the relationship between the fundamental metrics with which SaaS companies like Palantir, Snowflake are usually valued. So a combination of revenue growth and free cash flow margin, that compared with the valuation. And when I made this chart was at the beginning of the week, Palantir touched $20. Basically trading at almost 20x EV sales. And we can see the relationship, how Palantir relates to all the other companies with similar metrics. Right now, Palantir grows neither 20% in terms of revenues, and it has a free cash flow margin of around 20%. And the management said we expect to keep the rule of 40, that's how the combination of these two metrics is called, around 40%, meaning that the management said last quarter, we will stay at least at 40% in terms of 20% growth, 20% margin as combined. That's the gross idea. So this also supports the fact that probably the guidance they gave of 13%, 12% is actually a very low guidance. Also because historically they exceeded that guidance by 3%. Just to jump a little bit to this other chart, here you can see basically the revenues, the comparison between the guided and the actual numbers. Usually there is that 3% more they give every quarter. They gave now 13% guidance, so it is reasonable to expect that the number should be closer to 16%. But even if it is 20%, that is actually great. The problem is in the valuation. Unless the management gives clear signs that even that potential 20% is actually low compared with the real fundamentals unlocking of the company. So the story, the problem is when the valuation is already this high, you require a lot of growth to justify your valuation. Snowflake is here having the highest valuation in terms of software companies, mainly because it has very, very strong growth. Here, this almost 80% comes from a combination of revenue growth around 50% and around 30% free cash flow margin, more or less. The problem with Palantir is that it has a great free cash flow margin and the growth actually sucks.
So,
if you look at it purely from a fundamental standpoint, paying 20x revenues or so for a company growing 15%, that's laughable. But that's the story unchanging. That's the story changing, the story unfolding, I would say. So we need to remember that while it is important to have a sense of how good the numbers are for the quarter, what the market really cares about is not the beat on the quarterly number, but the outlook that the management is able to share, because that drives the future growth. So my personal expectation is not very detached from what we just discussed, probably something around 16-20%. But I would say that's neither the most important thing. The most important thing is the number of clients keep increasing, hopefully with the highest quality possible, but a clear direction that what was just a dream months ago with Carp last year, as we discussed also during the spaces. Carp said in 2022, we will hit 4.5 billion in 2025. And to get that, you need way more than 30% growth. You need like a 30% growth. With a 30% growth, if you are able to give confidence to the market that you are going to achieve that, not only for 1 year, 2 years, but on a consistent basis, there is where you can justify a high valuation.
Yep.
So I would say here is not only a matter of the numbers that come out, is a lot in terms of how the management is able to share their confidence into the future. Are there any basis for that? Because otherwise, the market, and we will see also with analysts, they will still be anchored to the crappy things. Consultancy. There is an analyst who reiterated it's $5 per share. Frankly, I hope he's right, underscoring the SPACs. And SPACs are still there, like basically almost all failed. This has an impact on the revenues, obviously, because SPACs were actually a nice contributor to the growth. They were small, but the revenues compared with the size was actually high. It was around 8-10 million per quarter, or no, per year, per each SPAC. So having almost all the SPACs failing, that inevitably impacts the revenue. But again, if let's say all SPACs die, but the management is confident in sharing, look, okay, let's move on. The clients we acquired outside SPACs are able to grow consistently and match. Who cares about SPAC? For instance, you see that Dan Eves neither mentioned the word SPAC, neither one time. While for other analysts, SPACs is all what matters. Obviously, that's a bear argument, and you see also the bear cave hitting at that. But frankly, I would say at this point, the revenues were collected, the R&D was done. It's like if you make one bad trade as an investor, does it mean that you are a stupid investor for the rest of your life? No. You accept what you did, the good and the right, and you go on. I think that's the case.
Yep, I agree. Colin, I see your super chat. I'm going to get to it in a second because I think it's a really interesting question, but I want to end off the earnings prediction segment of this with this question. I want the chat to participate, and then you and Matt, you probably got to take a minute to think of this. I want you to give me one dream scenario for Q2, meaning like if one metric in which you assume, oh my goodness, they did it, and it blows you out of the water. And then I want you to assume the opposite of that. So two things. The opposite is one thing that could go to shit. The caveat is you have to have a logical reasoning for that. So here are some of the metrics. Customer count, GAAP operating margin, cash from operations, adjusted free cash flow, revenue, US commercial, US customer count, GAAP profitability. Think of some of the main metrics we're all looking at, and think of one dream scenario that they just hit it out of the park, but some logic behind that, kind of like Matt was saying with international growth. And then one metric where they shit the bed, but also logically why they might be able to shit the bed on one of those metrics. I'm going to go first, so I'll set it up and then you guys can go. I think my dream scenario is customer count, and they hit it out of the park. I'm not going to give a specific number, but let's just say they hit it out of the park. And my logic is AIPCon 2 is in September. So the type of logic I'm justifying for... Can you guys hear me? Yeah, we're still good, right? Yes, we're good. Okay. So the type of logic I'm giving for why they hit customer count out of the park is because they're having a second conference with AIP. So that second conference, I'm assuming, means they're not just doing it for marketing. They have a lot of customers, even if they're not getting the revenue from it yet, that have signed on to this AIP platform. Plus, I'm putting the dots with Dan Ives talking about talking to all the CIOs. They're saying Palantir is the big thing. Carp saying we have more demand in 12 months, blah, 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 blah. So customer count hit out of the park. That's my biggest metric that goes up and does really well. My shit the bed metric, honestly, might be stock-based compensation because they are hiring more people. They do have to start paying more for sales and marketing. More logically, stock-based compensation should keep going down, but I think Q1, it made sense for us to go down from Q4. Q2, it should tick up a little bit if we're seeing a little bit more hiring and a little bit more sales and actually getting more deals done. And so stock-based compensation might go up, not aggressively, but it might go up to the point where it's a little annoying. Hopefully still keeping that 27% decline year over year. So my dream scenario, customer count goes through the roof and the market's like, holy shit, AIP is real. Shit the bed scenario, stock-based compensation goes up a little bit too much and it's a little bit annoying. Matt or Arnie, who wants to go second?
Well, let me touch what you just said, because that was something I wanted to underscore. So far, we have been seeing the stock-based compensation declining, and this was one of the most exciting things to gradually track, because especially in this December, the market started having a allergy. They couldn't touch anything that has stock-based compensation around the year. But the reality was, okay, that's a risk factor, that's a negative thing, but if you incorporate into the valuation, and the valuation makes sense even without you, if you consider the headwind, that's fine. And the most important thing is these numbers to gradually go down, because this means not only it is good in terms of perception, but that is what allowed Palantir to become not only operating profitable on our operating side in terms of free cash flow, but also in terms of GAAP basis. And we know how much the market wants that. However, there is this sentence that I think is important to mention. Q1, the CFO, while we expect to see stock-based compensation expense trend up through the remainder of the year, we remain focused on GAAP net income and operating profitability.
So they're expecting it.
So they already said, okay, probably it will be not 115, probably 115 will be the kind of a bottom. But even if SBC trends up a little bit, they want to stay GAAP profitable.
Right.
Which means that right now the stock-based compensation has around 20-24% impact on revenues. If they want to stay GAAP profitable, it means that that's the most stock-based compensation can hit, because otherwise you don't get the profitability from a numerical standpoint. So that's the negative side of what you just shared. In terms of the metrics I'm following, sorry, let me again. I insist that every time this is the most important metric, because if the number of customers explodes, now we are focusing more on the commercial side. We know the government is slower, and the big bet in terms of growth is on the commercial side. The government side is more, you need to keep your dominance. Here is the big bet. And so far, the number of clients is growing well, but naturally, as this number increases, it is also very harder to it is also harder to keep that percentage growth steady, because with a bigger base, growing 2x 50% is very hard. But this is exactly why this would be the dream metric, because in the last quarters we saw the growth staying around 50%. The comparison is tough because here in 2021 we had the SPAC explosion that helped the US commercial count client commercial count increase, and now we are making the comparison without having the SPACs. So this number is impacted negatively by having SPACs who left. So in Q2 we will see SPACs disappearing. And this is exactly why, if here, rather than a plus 50% increase in the customer count, we see a number like 100% because the number of clients from the US explodes, that would be the biggest possible hint. If that happens, I neither care if revenue grows by 13%. But at the same time, since this metric is the most important thing, that's also my shit on the bed metric.
Yeah.
Because if we see this metric decreasing very much, that is potentially a warning sign. While it's not necessarily a warning sign, because when AIP was shared, it was April, May.
Yeah.
Time to make the demos, time to make the event. The events were in May or June. So it takes time. And even if they have unprecedented demand, maybe they are all on the pilot phase. So
right.
As every number, we need to understand why a number is high or low. But I would say, given the importance this metric has, we need to understand what's the dynamic inside here. If the number explodes, good. There is no question marks. Things are definitely working well. And with that, I neither care if, like, I would pay zero attention to the revenues if this number explodes. But if it doesn't, we really need to understand, okay, what VF is going on, because that could be an okay sign or could be a very warning sign.
Yeah, makes sense. Matt, any dream scenarios and any things that might go really bad?
Yeah, so I hate to beat a dead horse, but I agree. I wasn't thinking about the commercial specific side, so I appreciate Arnie bringing that to light. I was thinking more just along the total customer count, being about 475, which would make, year over year, I think my forecast was about a 42% or something like that, at growing to 440 or so clients, up from 308. Going to 475 would make it about 50% for the entire customer client base. And so that's kind of where I was thinking in terms of that. And the reason being is, and I'll do a brief talk. I won't talk too much about it, and then I'll get to where I think we're most at risk is, or that would be very surprising for me on a downside. I think Apollo, in terms of, while I agree it's a great product, I don't think it's had the amount of hype to the extent of AIP. And my hope is, with additional usage of AIP being more towards the non-technical user within organizations, and it being more of like a chat GPT sort of usage for enterprise, that you now have the need for more use of Apollo security rights, allowing people to have different versions and access to different parts of the underlying sort of Foundry workbooks and databases and stuff of the like. So I'm hoping that the continued intermingling of all these different products continues. And what I will say is I think the reception of AIP has gone extremely well so far, in terms of AIPCon and the amount of buzz that's kind of happened within the organization from an institutional standpoint and a retail investor standpoint, as well as folks that have seen the demonstrations like myself, CodeStrap, and others. It's reignited kind of my love for what Palantir is truly doing from a software perspective. And so I hope that kind of kickstarts that customer growth, compared to what Apollo has done, which I think very few have really uptook Apollo as much as I'd like to see at this point. And I think it's truly one of their most underutilized products, or actually the most underutilized operating system that Palantir has kind of created thus far. And I hope that continues to have a longer wavelength, because I think people don't fully understand that applicability yet. Now, moving towards, I think, on the downside, the thing that bothers me the most, which I'm hoping AIP might not necessarily have a huge impact in this quarter, but I hope will ignite the company in the following quarters, is net dollar retention. And I've seen that continue to go from 150% to 130%, now towards, I think in 1Q or last year when I was doing some looks, it was like below 120, it was like just above 110%. So what I'd love to see is that continue, back towards the up and to the right. And my hope is that with AIP, the continued usage of more non-technical folks in organizations, and all that continued usage of, in the background usage and creation of data, and all that just allows you to expand and reignite that top 20 client revenue growth that we've kind of seen has always been in the 10 to 15% range, and continue to grow that back towards where we are. And my hope is, just getting back towards everything, kicking it back to the overall revenue growth and hopefully kickstarting, then I'll kick it back to the room, is I think that, and my hope is that they might have used the Apollo sort of rollout and the lack of buzz in terms of what they think might happen with, say, AIP. And my hope is that AIP is a completely different rollout in terms of customer appreciation, growth in the organization, and that basically demonstrates and kickstarts back the revenue comparatively. I think everyone understands that, but I'm hoping that management kind of saw what happened with Apollo, hoping that Apollo would be a much bigger rollout, and then muted kind of what they think the anticipation was for AIP. And I hope that AIP basically blows them out of the water with the reception. And I think that's kind of what Karp has been saying, but fingers crossed. And once again, there was only really 1 month of AIP true rollout in 2Q. And so I think you need a little bit of love between now and then and time before we truly start to see the results show up.